hear me, which I think you can. We're going to start, and welcome to today's Advanced Estate Planner webinar on income tax and how income tax is dealt with in Estate Planner and how to use its functionality. So first thing just to say is that, Estate Planner is not a tax-driven program. It's it does take into account tax issues, but not at a high level where you're talking about estate freezes or things like that as of yet. So let's just start. I'm going to share my screen, and I'm going to show you some basics and then some more advanced issues. And always feel free to interject with any questions either on our chat, which I'll keep open, or just live. So thanks, everybody. And then what we'll do is we'll do that for about 20 minutes or so, and then we'll open the floor to questions for anybody who has specific questions, not just on this, but on anything that they're dealing with on Estate Planner. So the first place that we want to check is in our assets. That's where we're going to put our income tax. And many of you are aware that assets have a value in a probate tax that's calculated automatically, but not income tax. So income tax is a manual calculation for every asset. And we did that deliberately because we felt that we were lacking the information that would be necessary to estimate that even. So we decided to leave that as a manual calculation. So just a very basic thing is on death, there's a trigger of capital gains. With an exception for depending on certain planning, but there's a trigger of any accrued capital gains. That's how our tax system works. The couple of things, there's no accrued capital gains tax on principal residences. And for registered assets like an RSP or a RIF, there's a deemed inclusion of the full value of the asset as income, not just the gain, but the full value. So those are the three major issues, three different kinds of assets that we've got to think about. So in this case, we're dealing with these are private company shares, and we've put down a value, or the client has put down a value of $1 million. Well, we're not going to know what the income tax is necessarily. We're going to need some information about what the cost base is and things like that to calculate the capital gain, et cetera. But what we're going to do is we can either put nothing in, or we can just ballpark some amount as a placeholder if we don't have any idea of what the tax implications will be. So that's about the best we can do. So, and that's the way I deal with things. Basically, for anything that's cash, we know that there's not going to be income tax because cash has no accrued capital gain. For other property, appreciable property, we're going to consider what the purchase value was, what the current value is. That will give you some idea of what the gain is. And the way we calculate that for rough and ready is, in this case, they bought it for 100. Its value is 200. That would show a capital gain of $100,000, the difference between those two numbers. 50% under Canadian income tax law, 50% of that, or $50,000, is included in income in the year in the deceased tax return. And the highest marginal rate is about roughly 50%. So that takes you down to 50% of 50,000, which is 25,000. And so that's also equal to 25% of the gain. And that's the number that I typically use. So if I see a gain of $100,000, I'm going to put income tax in here, as I've done right here, $25,000. And that's a rough and ready calculation. We're not going to be precise about this unless we've spoken to the accountant and they've told us, and we know A, when the person's going to die, and B, what the value is going to be at that point, and all of those other things. So that's why this is just a rough and ready kind of calculation. So I will add those kinds of numbers through my, when I add assets. You can always go back to certain assets and change them and add, if we talk about this investment portfolio, we know the client looks at their statement and says, okay, it's $450,000. They may have no idea whether, there's any accrued capital gain. So what do you put in for income tax? Well, you might leave it at zero. You might say, do you own any equities in that investment portfolio? And if so, have they gone up in value? Yeah. I own 10%. Well, okay, that's 45 grand. So what's the, you're ballparking real, just rough and ready numbers kinds of things. For registered assets, so if I have an RRSP, whatever the client tells me the value is, I'm going to basically put in 50% of that as income tax in here. And again, it's just a rough and ready. It'll depend on what their income is at the date of death and all the kinds of other things. But it gives them some idea of what the impact of certain decisions will be. So that's how income tax, basically, you put in income tax. For example, life insurance, as we know, has no income tax typically. And so, if they have $1 million policy, there's still going to be no income tax, right? So that's sort of how we do the input of income tax information. You're always going to want to put in the largest amount of income tax that's a possibility. So, for example, take the investment portfolio. Yes, there might be a rollover if you give it to the spouse, but eState will take that into account when it shows you how to save tax. But assume there was nobody alive and it was going to me, well, there'd be tax triggered, right? I'm not a family, I'm not a spouse, I'm not a charity, so there's going to be tax. So put that amount as if there's no tax relief at all in there for the income tax. So I'm just going to pause there for a second, see if there are any questions about putting in the income tax number. All right. I don't see any. Good. Okay. So let's then move on to how we plan for that income tax. So once we've put in that income tax, if we go to the first scenario, let me just clean this up a bit. And we'll assume we have got nothing in here at all. So what we can show the client on the summary button, right? So there's the summary button in the scenarios page beside the asset summary. This is where it shows all the assets, and it shows the income tax and probate tax that would be triggered if we did nothing, okay? So once we start planning, you will see that the income tax, and we're speaking about income tax, but also probate tax, will be eliminated depending on what we do. So, for example, we've got the spouse is Jane. If we say, okay, the RSP, let's designate that to Jane, we drag and drop it. If you go back to the summary now, you'll see that the client has saved $250,000 and $7,500 of probate tax based purely on the fact that you're designating the spouse as the beneficiary of the RSP, right? And that all makes sense because there's a rollover and it knows that Jane's a spouse. So if I put in, some other beneficiary, Jordan Jones, I don't even know who that is, but if I had done that instead, I'm assuming they're not a spouse, the income tax would not be saved, but the probate tax would be saved. So it knows who the people are. And that applies for any assets that you pass through to Jane, either as joint or designated assets. So if for example, if the shares or let's take the country home was held jointly, that would eliminate that tax on that property as well. Okay, so that's how income tax is dealt with on joint and designated assets. Similarly, if you give a property that has an accrued capital gain to a spouse as an initial gift, it would save the income tax. It wouldn't save the probate tax, but it would save the income tax on that asset. So you can see there, we've saved a bunch more income tax just by making Jane the beneficiary of that. So you can do that. It'll affect in initial gifts, but if we delete that for a second, and you'll see the income tax has gone back up. But now if we give the residue to the spouse, for example, as an absolute, well, we've just eliminated all the income tax. There's a rollover. And the same would apply if you did a qualifying spousal trust. So if you picked from our list of macros, trust qualifying spousal trust, it eliminates all the income tax because it knows that this is a qualifying spousal trust. If this wasn't a qualifying spousal trust, it wouldn't eliminate the income tax. So income tax, is pretty basic on the spousal rollovers. If you only gave the spouse a percentage of the estate, what estate does is sort of multiplies that percentage by the income tax if you're giving them a residue gift. That may not be precisely accurate because it depends what assets are going to be rolled over and et cetera, but it shows them that there's some tax issues there. So that's really, and as we all know, we don't have that much we can do to avoid income tax. We have a fair bit we can do when the spouse is alive, but we can't do much when the spouse is not alive. And so, there's going to be a capital gain triggered, and there's not much you can do about it. So that's that. The other point. So let's just take this scenario. So this is, the kids, the spouse is not alive. I've done a whole bunch of gifting here. I do want to show you one thing about income tax. So in this case, we've made Jonathan Jones the beneficiary of, let's just get rid of that, of these shares. The instructions are, I want Jonathan to get these shares directly. Now, Jonathan's not a spouse. So if we go to our advisor alerts, it's the very first alert is that we've given shares to somebody, but we haven't considered the income tax implications of that gift because he's not the sole residuary beneficiary. So that's a very important warning. Now, I try to avoid specific bequests if I can because they bring into account all kinds of tax issues and state administration tax and other things. So, okay, we have this warning. Well, what do we do with this warning? Well, what we do with this warning is we go back to that gift and we look at conditions because probably we want to we definitely want to at least canvass the client on whether who we want to bear the tax on these on these shares. Do we want the estate to bear the tax, or do we want Jonathan to bear the tax? If we want Jonathan to bear the tax, we go to conditions, payment of income tax, and then save. And now what it'll say is you get those shares subject to on a condition that you pay the income tax that would be triggered on my death. Because otherwise, of course, the estate, the residuary beneficiaries are going to pay that income tax, which might not be fair since they're not even getting the assets. They're not even getting the assets and they're paying the income tax, which could be a huge number. So planning that warning. And now if you go back here, you'll see that warning is gone. Right? So I think there may have been a question or two, so let me just see. Will it show the part if the client donates part of a non-registered? Yes. So let me just show you how that might work. Just talk about charitable gifts. So if we showed the income tax here of $685,000, right? So we talked to the client about making a charitable gift, and we decided the charity we're going to give to, is the World Fund, and we're going to give $100,000 to the World Fund. Well, that's going to save about $44,000 of income tax. Okay. And that will work if you put the gift as an initial gift, or if you put it as part of the residue. What we're working on actually is the implications of specific bequests of shares and of RSPs. So those are coming, but not yet in the current version. But there shouldn't be much longer as we develop that. So that's how we deal with charitable gifts. And I just want to talk about how you add charities. So if it's a beneficiary and it's a charitable beneficiary, and you don't have them in there. So let's say it's I don't know, Camp. There's some Camp Hope is the name of the charity. Well, if I start typing in Camp Hope and the name doesn't come up, I know I haven't already entered them in there. So what I need to do is add them as a new charity. So add new charity, and then I would say Camp Hope, and I would look them up on the web, on the CRA website, and I'd find out that their registration number is this. And I'd put that in the name. So I don't put that in the ID, but I put that right in the name. and then I go add, and then they're always going to appear as a potential beneficiary in my list of charities. So if I added them in here, and then I went back and I wanted to add them again for whatever reason, you'll see they appear if I start typing them in. So you only have to add them once, and then they're in for all other clients. That's the only kind of beneficiary that shows up across the all clients. So that is how you deal with income tax. And I'm just going to make a note about, if you wanted to talk about probate tax, but of course, probate tax is saved through using joint designated assets. But if you want to demonstrate the impact of using multiple wills to avoid probate tax, if you click on this button down here, but in the summary tab, at the bottom, there's apply multiple wills. And you can show that, yes, if we use multiple wills, we're going to save you $41,000 when you die. Of course, these numbers, yes, they're not guaranteed. It depends what's owned at the time of death, but under this current situation, that's what you would save. Do you want to do that or not? And what that's doing is it's calculating with a probate tax on assets that you can usually put in a secondary will, which are personal effect, shareholder loans, private company shares, assets held on a bear trust. Those are the ones that you can deal with and that are automatically calculated in here. So that is what I wanted to talk about from an income tax planning point of view. Anybody have any questions, suggestions? Does the CRA number appear in the will? Yes, the CRA number does appear in the will. So if I think I made a gift, did I make a gift? Yes. So let me just show you. I'll just generate a will here, and I can show you how it comes out. So one of the first things I ever thought about when I was doing this is, wouldn't it be great if it automatically linked to the CRA website? So we're actually working on a way that might work. So that would be fantastic, because you'd have immediately, it would put in all of the information that you'd need. So anyway, we're coming at some point, probably not the highest priority, but anyway, the good thing is that once you put it in once, it's there. So I've, now I have probably 25 charities in mind, just because I've added them in one at a time and they stay there. So can you talk about someone who has a sizable non-registered investment account in a cottage? As the accountant is recommending they create a corporation. Yeah, so I'll show you how to deal with that. Basically what you're doing here is some probate tax planning where you put a bear trustee or a nominee, basically a nominee on title to the property and to the registered accounts, who are holding it as a bear trustee for the client, for the holder, so that there's no disposition for tax purposes. There's no transfer of beneficial ownership, because all you're doing is putting the name of the corporation on title. They're legal title, but not beneficial title. And so what you're hoping is that CRA will take the position that there's been no deemed disposition, because you're not transferring beneficial interest. And I'll show you how you can demonstrate that. Just give me 1 second. So I'm calling up the will that we just sort of prepared, and hit enable editing, because I want to click yes to the field codes. And you'll see here, the first thing I want to show you is this idea of the conditional gift of the shares to this guy, whoever it was, Jonathan, but subject to him paying the tax. So what we've said is the transfer of my shares is conditional on, in this case, assuming encumbrance, if there was any encumbrance on it, but also paying any income tax. And so that's how we draft that in there. Here's how the World Fund, so it was built in there. So it comes out with the ID number. But remember, don't put the registration number in the ID field. We're actually getting rid of that ID field. Put it in the name. So I just type it in the World Fund bracket name of, and I copy it from CRA. So that's how we I'm just going to go back for a moment here and show you how I would do that. So we have an asset here, this investment portfolio. So let's say it's worth, $5 million. Okay. So actually I did it here. So it's worth $5 million. And right now you say it's owned solely by this person. Okay. Well, if it was owned solely by that person, you'll see the probate tax would be this amount. Okay. 145,000. Even if we applied multiple wills, there'd still be $111,000. So there's still a lot of probate tax. If we now show the client, now look, if we took that investment portfolio, which was worth $5 million, and we put it in we have a trustee, a bear trust holding it, like a nominee corporation. Now let's go back to the scenarios. And if we apply, right, we have that 145, if we apply multiple will strategy, now we're saving $117,000. That includes the $75,000 from that $5 million policy that's now held by a bear trustee. So you can demonstrate the benefit of holding an asset by a nominee corporation. And when you did the multiple wills, one of the assets in the secondary will are something called trust assets. And trust assets are assets that are held in trust for the client. And in that case, what you're doing is it's going to be part of the secondary will unless it was disclaimed. So right here, you'll see one of the assets you'd want to include in your secondary will would be trust assets. And then the secondary will would govern that asset. Why? Because you wouldn't need probate to deal with it. It's held by, looks like to the bank that a corporation owns it, but they don't really own it. So it's really governed by your will. So that's that. Hope that made sense. Let me just go back to the scenarios. Sarah had a question. Are there certain scenarios that a client should always be advised to have the beneficiary of an initial gift or a portion of the residue pay the income or probate tax? What do you recommend as far as a trust for minor children? So, yeah, I mean, I would always raise that. Whenever I'm making a gift, a specific gift of something, that's why I built this to have this advisor alert to warn us, because it's the most common error that serious error that lawyers make, is that they say, okay, the client says, oh, I want to give my house over here to this person. Well, great, except that house is not a principal residence and it's going to trigger tax, and they're giving the residue to someone else. So anytime there's an initial gift, it is something that you should consider with the client, in my view, whether there should be some sort of conditional gift, and that's why we have it as a warning. Okay. So that's the first thing. Now, some things don't have income tax, so you don't have to worry about them. So if you're giving a bank account to a beneficiary, well, that's not, I mean, it may still warn you, but it's not an issue that you have to really worry about, because there isn't going to be income tax on a bank account. But that's different. And there's similarly, if you give a cash amount, there's no requirement that you pay, there's no tax that's paid by that beneficiary, right? The tax is all paid by the estate. And that's that. And as far as questions about trust planning for children, there's a couple of factors that go into that. The first is, what do you want, how much is at stake here? So for example, if we're just taking the very simple, let's just divide everything equally among my children sort of thing. I mean, the things that I'm going to worry about are, how old are the kids right now? So if we're holding it till 40 and they're 9, so we got a long way to go. So that the length of the trust is going to be important. How are they at managing money? Why are we doing this? Like, what's the reason for holding it in a trust for a long period of time? Typically, I would start with 30 and move backwards. But if it's a small estate and you're not, the longer, there's a downside to everything. And the longer you hold it, the longer you got to pay a trustee to do it and worry about it and all of those other problems. So I think those all kind of fit into the duration issue. And, mandatory payments, the idea of using staged lump sums or something like that, I'm always worried if I've got young kids is, the thing about a mandatory payment is that it has to be paid. So if it's a bad idea, but they get it at age 25, they're still going to get it at age 25 if you've built it in. So that's just, you got to just canvas that, I think, with the client. I hope that helps. And happy to stay on and talk about that some more if you want, sir. So, any other questions? Maybe on mic or unmute, and if you can speak up.
Brody, what does your conversation look like when you have demonstrated the planning with a client? So, many of the assets go through designated or jointly owned, and then you've got a tax balance at the end, and there's not a lot left in the estate. What's that conversation look like? Where
there's a negative, in other words, like there's, I mean, usually if you're giving assets away, be to a non-spouse really, because if you're giving it away to the spouse, then there's going to be a rollover. If you're giving a bunch of assets to, if you, in this scenario, you're giving a whole bunch of assets to Rachel, and everything's joined and all of that, there's not going to be any money left to pay the tax. And I think that's what you've got to say to them. Like let's do this right now. We bought a summary. We got negative $896,000, right? So I can say to the client, and I want the rest of it to go to this person, to Frank. Well, poor Frank's out of luck because Frank's going to get nothing. But the other thing to warn them is that, CRA has access to the beneficiary of an RSP for unpaid taxes. It's a joint and several liability. So if the estate says, oh, sorry, I have no money to pay this tax because there's $636,000, well, the CRA is smart enough to know that wouldn't be a good idea. So they have a right to go after the recipient of the RSP, Rachel, for that tax. So that's the discussion I'd have. I'd say, and this applies whether it's joint gifts or you've given away a whole bunch of legacies, and that's one of the benefits of using numbers is you can say, look, how much do you think is going to Frank at the end? Oh, I think Frank's going to get $1 million. Well, let me just show you. Frank's not getting anything. Oh my goodness, So that's the helpful.
Yeah, and I think it's when you do the insurance designations, right? If you do those alternative designations to kids, that's when you can run into trouble, right?
Absolutely. Yeah.
Thank you.
And it demonstrates that, really. That's the benefit there. Trevor has a question about changing the relationship between relatives. So Estate shows a sibling when it's really a parent-child. That's a good question. I don't think there's a way to change that relationship except to delete them and re-enter them. One of the things we've gotten some feedback from a number of people is that they have some trouble with a family tree and doing it correctly. So I think what we'll probably do, if people are having difficulty with that, we'd love to have your feedback where you're running into difficulty and how we can make it easier for you to create family trees. But if Frank was, not a sibling but was a parent, I don't think you can't sort of just move them around. You've got to delete Frank. Let me just double check, but so you can't sort of just change them. You got to delete Frank and add them as a parent. So, you delete Frank here, and then you'd say, okay, it's James's parent, as the father is James, right? So now it would create that relationship, right? So, and now we delete this guy because he's no longer a sibling. That's just the way you have to do it right now. I want to encourage everyone, as I always do, that, our tutorials, these are general big ones and whatever, but we always have the availability for one-on-one tutorials anytime. So if you haven't had a one-on-one tutorial with Michaela or myself, and you have specific questions you want to go over, or you got a bunch of questions, or you don't know what to do, you've started and you don't know what to do, don't wait, just jump on, schedule a tutorial, and we'll get right on it in a day. We also, just to remind you, we have this chat, we have support. So a whole support, many frequently asked questions are there. and you can search, if you've got questions about appointments or how do I do a balance of the estate gifts and what's a segment and, that kind of stuff. They're all here. But the other thing is there's a little chat button down here that pops up after about 5 seconds when you're on the support page. And now you can send us a message. We'll see it live and we can have a chat with you right then and there. So that's also a feature that if you have a short question and you want to, get Michaela's answer or get my answer, like how do I do a hodgepodge clause, and we can even cut something and paste it in there or whatever and have an ongoing dialogue back and forth. So we have lots of support and we hope that you take advantage of it because it's a big, it's a big learning curve. And, but we really are so thankful for those of you guys who are doing it and trying it and putting the effort in. It's really wonderful and we really appreciate it. And anything that we can do to make it easier and better for you, let us know. We're working on a new release for the spring. And I know we're in the spring. We're in the spring right now, so that's good. Hopefully by the end of the spring, we will have some new features to share with you. So that's the thanks, Blake. Yeah, any other questions? And I'm happy to stick around for some time and answer questions that people might have. Except what's going on with my hair, that you can't ask me. I mean, I'm doing my best here. Any topics that people want to talk about for next week? We're thought about doing a macros one, how you can use the power of macros and how those work and how to set them up and customize them and things like that. Any questions? Any topics you want to talk about? I'm happy to stick around, but I usually try to keep this to to half an hour or so.
So Jordy, it's Fred. One of the challenges I have is doing providing the service to the client and using the tool, and not chewing up so much time. So it's not the tools issue. It's usually the issues with the client and walking them through. And what's the what have your learnings been in terms of your use of the tool and demonstrating that wow and getting to the right answer and then closing off the file, having delivered competent, client focused service?
Yeah, so I can do a meeting. I mean, the worst part of the meeting is getting the data. So if they haven't put in the data, that is going to take some time. Now, the reality is it takes time whether you're using a program or not, because you got to write it down or something. So what I'm thinking of implementing is a pre-meeting call with the client, with my assistant, saying, okay, we've looked at what you filled in, and have a checklist, because we have pretty much, questions that we can ask about all the assets to shorten that period. Because my experience is that once we've got this, I'm going to show you, and I don't know if I've shown you, we're going to build this right into the program, but I have these planning slides. So the first thing I do, even before, once I filled in the data, I take them through this model and I say, okay, here's how we're going to plan your will.
Are you sharing?
Oh, thank you. I am sharing, but I'm not sharing. I have these slides. Okay, so here's how we're going to plan the will. And this takes all of 2 minutes. We're going to plan 3 different scenarios. So I want you to focus on that. We're going to talk about 2 options for gifts. Right? And that's that's the model that we're going to use. And it provides the structure for the client and what a will looks like. So I spend literally less than 5 minutes giving them this overview, because this we return to all the time when we're trying to make decisions. So that's 5 minutes. And I wouldn't spend more than 5 minutes. And then what I do is I turn first, before I get right into the planning on eState, is I say, okay, let's deal with the first scenario. And here are your options. And here's what we can do. And I just basically show them about how a spousal trust works, and how, how you give everything to each other. And so I have, this kind of, again, I'm a big believer in limiting options for clients to so that they can keep their head. So that's what I'm trying to do. And so I spend, maybe this is a 2-minute conversation because they're like, yeah, no, we're giving everything to each other. Great. So now I go into eState, and I'm in this scenario. And so I just do the demonstration. I say, okay, and again, this is no more than 5 minutes because I just say, okay, Jane's getting that, and the home is joint, and the guitars are joint, and now let's just talk about general personal effects. They're all going to the spouse, so I can just drag them and just say, okay, he's getting those. And you said you wanted everything to go to the spouse with no strings, right? So that's a macro I would use. I would just go run macro and say spouse absolute. Well, I've just done the first, so I'm a third of the way down. And that might either be the more complicated one if you've got a complicated situation with spousal trust, things like that, or it literally takes 10 seconds. And then you can at least demonstrate to the client, okay, here's what we've done. We've saved you all the probate tax or all the income tax and probate, and then I just move to the second scenario, and I have a slide for that. And we're going to build this in, but I'm happy to send it to anybody who wants it. And I'm contemplating just sending it to the clients in advance, so they've sort of done that. They sort of know what I'm going to talk about. But here, okay, what are we going to think about in the descendants only scenario? And here's how we plan the trust. Great. So let's now turn to eState and plan the trust, right? So we're descendants only, and you talk to the clients, and they say, yeah, we're going to need a trust for the kids. So, you start with, maybe you just build that in, start with this, and you can say, okay, let's just talk about it. Are you good with them getting into 30? No, I want it to be 26. Okay, no problem. And do you want mandatory payments? Well, let's talk, what do you, and then you just sort of work this through. But everything else is done for you, and so you've done 2/3. So in my experience, the planning meetings in a simple situation, definitely less than half an hour. In a more complicated situation, 45 minutes. But the collection of the data, that's something, we try to streamline it. It's never easy, and we'll get these slides to you guys.
Yeah, it's definitely reining the client in is that takes the most time, I think.
Yeah.
And then doing the due diligence around the real estate searches and, that kind of thing.
Yeah, there's not much you can do aside from, that's what Law Pro would tell you is the problem is we're not spending the 45 minutes. People are spending the 5 minutes, and that's it. And that's where errors occur. But, I find that it works. It keeps the first thing it does is it's a process, it's a structure. So it keeps the planning meeting going without people jumping back and forth and all over the place. So that I find to be very useful. And, I book 45, I book an hour for a planning meeting. But I do give them a bit of that, education stuff. I find it very useful so that they have an idea of what kind of options are out there. So that's what I would say to you. I don't know if I answered the question, but I hope I did. Yeah, so if you're, you don't have to put any of the income tax stuff in there. All of this stuff is optional. So if you don't want to put any income tax in and just say, look, I'm not showing you any implications on of any decision. I don't want to show anything, then just don't put anything in there. The probate tax you might as well just show, but just so they get an idea what's going to be happening. But you can always override the probate tax and just change it to 0. Right? You can do manually. You can change it, right? So anyway, anything else? Well, great. Thanks, guys. Keep the questions coming, and yeah. So we'll have another one next Thursday. Hope you can join us, and until then, feel free to email and get support, set up a tutorial. All right. Thanks, everybody. Take care. Oh, there was a quick question, sorry, about gifting RSPs, RESPs. Yeah, so what I do for RESPs, it's a good question. So if I have an RESP, let's see if I have one here. I would plan it under both scenarios, but in the first scenario, I'd give it to the spouse as the successor subscriber. And then I would give it in the no spouse or the descendants only, I would give it to the children. And then eState would draft that appropriately. It would say if I'm a sole subscriber, I will appoint my spouse to be the successor subscriber. And if I'm the sole subscriber and my spouse is not allowed, I will be held by my executors and dealt with, etc. So that's how we deal with that. So I can quickly show that without much trouble if anybody's interested. So if I have an RESP, and what I would do there in the scenarios is I would drag the RESP in here to the spouse. I would just say spouse, pick the spouse and go add. And then in the notice in the descendants only, I would drag the RESP and say children. And I'll just show, oops, not grandchildren, children. And I'm just going to, just to show you what it does, I'm just going to generate the will, just so you can see. We're expecting, by the way, that these documents are going to get generated in seconds as opposed to a minute. So that'll be good too. So I don't know. Thanks everybody for staying. I don't know if anybody else was interested in this. If there are other topics, let us know that you'd like us to go. Yeah, I'll show you the RESP is not going to go to the kids. It's going to go to the executors to maintain for the kids. And I'll show you the drafting for that in here. Anybody got any other ideas for topics that you'd want me to cover on our Thursday advanced webinars? You don't have to tell me now. You can always send me a note and say, could you explain again multiple wills or how the provisions tab works or, you know, that kind of thing. So happy to customize it. It's amazing how long 1 minute can take when you're waiting for it to generate. So second family scenario, sure, good idea. We'll do blended family planning, how to add blended families into the people tab, and maybe some use of spousal trusts and things like that. So that's a good one. Thanks. So here we go. And all right, everybody's on the second family thing. We're on it. Here's just to show you what we've got for the RESPs. So they typically follow after the personal effects. So we've said here, if my spouse is alive, I appoint her as the successor subscriber for any RESP of which I am a sole surviving subscriber at my death. And then if my spouse is not alive, if at my death I am the sole remaining subscriber. And if any of my children qualify, and it knows if they have multiple children or if they only had one, it would have the name, etc. So if any of them might qualify, then you direct that the trustees continue the RESP for the benefit of any of my qualifying children, etc. So that's how the planning works. U.S. and foreign beneficiaries. Yeah, we don't have too much support for that, but we're actually working with a U.S. firm to add some planning parts to that. So, yeah, so obligations to former spouses, you would include show that there's a separation agreement, and then eState would include that. So I'm not sure if that's yet built in, but that would apply for a marriage contract or a cohabitation. I'll check if it's in for a separation agreement, and it would say, look, to the executors, I'm party to a separation agreement, and I want you to know about that and to fulfill any obligations I have. So we're at 1:15, guys. I'm going to wrap up for today, but feel free again to email me with any questions if we didn't get to them, and we'll go forward on it. Thanks so much, everybody.
Thank you.